Julian, what do you make of the market's reaction to the Jay Powell speech Friday?
Hi there again. Good morning. Yeah, I think it's predictable, right? I mean, I think as you pointed out in your introduction, he created this sort of divergence between tapering and rate hikes, and I think the market took that as a bullish tone. I think we saw risk assets, rise, the dollar come off, rates move a little bit. But the reality of the situation is this is all going to be highly data dependent. We think that they're going to start tapering in October and November, probably November. And that's actually, to our mind, more important to equity markets than rate hikes. Rate hikes are still a long, long way away. And we've really failed in the past to get through these taperings very successfully. They in themselves can do an awful lot of damage to risk.
Right, I'd call it a market freak out when it begins. Do you think that's still possible? That once it starts happening?
I don't think we're going to see a taper tantrum. I really don't. Typically, I think more important has been the equity markets. The bond markets are actually really pretty well behaved at the moment, and we're not expecting for big moves at the long end. I'm a little bit better. I think rates will rise in the at the front end of the middle of the curve. But the equity market is much more highly leveraged than it was back in the previous two attempts to taper. And I think that does create some risk as we move into, let's say, the fourth quarter, the beginning of next year.
The Wall Street Journal this morning highlighting that some of the hottest stocks on Wall Street are pointing to a potential economic cool down. Healthcare and utility stocks are among some of the best performers, but the Journal does note that these stocks typically see investors pile into them when they're anticipating a darker outlook. Your thoughts on the performance of these defensive stocks?
Well, as I said, I think we've seen an awful lot of money pumped into this market. Some of the survey data that's gone through is truly breathtaking from people like Goldman Sachs or B of A, how much money has piled in since the vaccinations appeared on the scene. So there's no question that if you're playing a game, you're coming to one of the last innings, and the Fed is beginning to taper. So I think a defensive stance, while I'm not bearish with the exception of a couple of sectors, I think a defensive stance is justified. Run your risk much more tighter than you would at the start of a bull run. This is a very, very mature market.
Liz Peek, jump in.
Good morning. I was reading a research note this morning that suggested that the utility stocks were discounting about a 1.66%, 10% yield, which sounds sort of gobbledygook, but basically investors have focused so much on the Treasury 10-year yield. Do you think that they're wrong, that particular instrument is more swayed by what the Fed is doing than by market forces and inflation expectations?
Julian?
I think, look, I mean, the long end is very, very, very influenced by what the Fed's been doing, and also by this Treasury general account. We've seen the Treasury run off, an enormous amount of money, over $1 trillion in reserves, essentially, that they had, which means that we haven't had to issue the debt. That's coming off to a certain extent. But we are, I think, in one of those phases of the market where if you're focused on the front end of the curve or the middle of the curve, in other words, you're focused on, is the Fed going to raise rates? Typically at that point, the long end tends to sit back. Right? It generally doesn't rise. Sometimes yields can fall. So I'm really not that focused on the long end of the curve. And I know the equity market loves it, but they need to actually bear in mind that that's at this point of the cycle, that's not how tightenings actually occur. They occur at the front end of the market.
Julian, thank you so much for being here this morning. Terrific discussion, as always. We'll see you soon.